Hi, I'm Wayne Plewniak, Head of Fixed Income at Gabelli and Portfolio Manager of the firm's credit-related products.
My name is Ron Eaker, and I co-manage the Gabelli U.S. Treasury Money Market Fund with assets of $5.3 billion. I focus on the short to intermediate term U.S. Treasury and government agency space. In recent weeks, short-term rates have begun to move lower as market participants anticipate a shift in policy, signaling the start of an easing cycle by the Federal Reserve. Fed Chair Jerome Powell confirmed this sentiment during his speech in Jackson Hole on August 23rd, where he said the time has come for policy to adjust. Markets are now expecting a rate cut at the upcoming FOMC meeting on September the 18th. The Fed is charged with a dual mandate, promoting maximum employment and stabilizing prices. While inflation has been the primary concern since March of 2022, Powell's recent statements reflect growing confidence that inflation is on a sustainable path back to their target of 2%. With the labor market cooling and unemployment ticking up to 4.3% in July, the focus of the Fed will now shift toward employment in its upcoming meeting. The critical question remains, how far and how fast will the Fed cut rates? Powell has indicated that future rate cuts will depend on incoming data, but he emphasized supporting a strong labor market. Market projections show expectations of 75 to 100 basis points of rate cuts this year and more in 2025. This suggests a Fed funds rate of around 4.5% by year's end and 3 3/8 to 3.5% by the end of next year. However, we believe they may move a bit more gradually, potentially delivering 2 25 basis point cuts by year end, unless significant surprises arise from economic data like this Friday's employment report. Now Wayne will discuss what these potential moves mean for portfolio management and investors.
Thanks, Ron. Building on Ron's points, the key question remains, how far and how fast will the Fed lower short-term rates? While the exact answer is unknown, we expect a gradual and methodical approach as suggested by recent Fed communications. Recently, we've seen some steepening of the yield curve, with the 2-10 spread still inverted but nearing positive territory. And we think this normalization of the curve is positive. The Fed is moving to support a continued economic growth with an easing policy to reduce market tightness created by its inflation-fighting policies of the past 2 years. While the Treasury's focus on short-term borrowings has helped hold down longer-term rates, a strategy that has helped hide the longer-term consequences of running large successive budget deficits, we will need to see just how much the Fed's cuts affect Treasury yields, if at all. Rates may already have much of the anticipated reduction priced in. As an example, the yield on the 10-year note has declined from 4.7% back in April of this year to 3.8% today. As investors prepare for lower short-term rates, a couple of observations. Money market rates may decline, but the impact on yields will lag due to existing higher-yielding securities embedded in the portfolios working their way through the portfolio, being replaced with lower-yielding instruments. The pace of rate cuts will have the greatest impact on money market yields. It may be time to shift focus towards total returns in fixed income by moving out of cash and extending a bit further out on the curve. Additionally, these actions might help to serve as an offset to potential volatility in the equity markets. Currently, we see attractive relative value opportunities in BBB investment grade and BB high-yield corporate bonds. As always, we will continue to monitor developments closely to navigate this changing environment and to provide guidance for you, our investors. Thank you ever so much.
Thank you.